Corporate governance is a critical component of ESG analysis because it directly influences how organizations are managed, supervised, and held accountable. Governance factors affect strategic decision-making, risk oversight, financial integrity, capital allocation, executive behavior, and stakeholder relationships. Investors increasingly regard governance quality as a leading indicator of long-term corporate performance because strong governance structures support sustainable value creation and organizational resilience. Conversely, governance weaknesses often contribute to financial underperformance, operational failures, regulatory violations, and reputational damage. Applying material governance factors to financial modeling, risk assessment, and management evaluation enables investors to gain a more comprehensive understanding of corporate quality and future investment prospects. In financial modeling, governance factors influence key assumptions related to growth, profitability, capital efficiency, and valuation. Companies with strong governance practices often demonstrate disciplined capital allocation, effective strategic execution, and transparent financial reporting. These characteristics may support higher expected growth rates, stronger margins, lower earnings volatility, and more sustainable long-term cash flows. Analysts may incorporate governance considerations by adjusting revenue forecasts, operating assumptions, capital expenditure estimates, or valuation multiples. Conversely, governance weaknesses such as poor oversight, excessive executive influence, weak controls, or inadequate disclosure may justify more conservative assumptions. Governance analysis, therefore, helps improve forecast quality and enhances the reliability of valuation models. Governance quality can also affect the discount rates and valuation frameworks used in investment analysis. Strong governance may reduce perceived business risk, improve investor confidence, and lower the cost of capital. Effective boards, transparent reporting practices, and robust internal controls can increase confidence in management's ability to execute strategy and manage risks effectively. Conversely, governance deficiencies may increase uncertainty regarding financial reporting accuracy, strategic decision-making, and future performance. Investors may therefore apply higher risk premiums or lower valuation multiples to companies with governance concerns. Integrating governance factors into financial modeling provides a more realistic assessment of long-term value creation potential and investment attractiveness. Governance considerations play an especially important role in risk assessment because governance failures often serve as underlying causes of financial, operational, legal, and reputational problems. Investors evaluate governance structures to identify potential vulnerabilities related to board effectiveness, executive accountability, internal controls, audit quality, shareholder rights, and ethical conduct. Weak governance may increase the likelihood of fraud, regulatory violations, accounting irregularities, excessive risk-taking, and strategic mismanagement. By assessing governance quality, investors can identify risks that may not be immediately evident through traditional financial analysis. Governance risk assessment therefore strengthens portfolio risk management and helps investors anticipate potential threats to long-term investment performance. A critical aspect of governance analysis involves evaluating the quality of management. Effective management teams demonstrate strategic vision, operational competence, ethical leadership, accountability, and a commitment to long-term value creation. Governance factors provide valuable insights into management quality by revealing how leaders interact with boards, shareholders, employees, and other stakeholders. Investors often assess executive compensation structures, succession planning processes, transparency, risk management practices, and stewardship of corporate resources. Strong governance frameworks support management accountability and encourage decision-making that aligns with shareholder interests. Conversely, recurring governance controversies may indicate weaknesses in leadership effectiveness and organizational culture. Management quality is also reflected in how leaders allocate capital, respond to risks, and balance short-term pressures with long-term objectives. Companies with effective governance structures often exhibit disciplined investment decision-making, prudent risk management, and clear strategic priorities. Boards play an important role by providing oversight, challenging management assumptions, and ensuring accountability for performance outcomes. Investors evaluate whether management decisions consistently support sustainable growth and stakeholder value creation. Weak governance may allow excessive executive influence, entrenchment, or conflicts of interest, potentially leading to poor strategic decisions and value destruction. Governance analysis, therefore, serves as a valuable tool for assessing leadership effectiveness and corporate resilience. Ultimately, applying material corporate governance factors to financial modeling, risk assessment, and management evaluation enhances investment decision-making by providing a deeper understanding of organizational quality and long-term sustainability. Governance influences financial performance, strategic execution, stakeholder trust, and the ability to manage emerging challenges effectively. Strong governance frameworks promote transparency, accountability, ethical conduct, and disciplined capital allocation, while weak governance can increase uncertainty and investment risk. Investors who systematically incorporate governance factors into analytical processes are better positioned to identify resilient companies, avoid governance-related risks, and assess long-term value creation potential. As ESG integration continues to evolve, governance remains a fundamental driver of sustainable investment performance.